In the world of investing, there's an ongoing debate that captures the attention of both seasoned investors and beginners alike. Mutual funds versus index funds. These two popular investment vehicles offer individuals the opportunity to grow their wealth over time. Mutual funds and index funds are both designed to help investors achieve their financial goals, but they do so in different ways. However, they employ different strategies and come with their own sets of advantages and disadvantages. Mutual funds are actively managed by professional fund managers who aim to outperform the market by selecting a mix of stocks, bonds, or other securities. On the other hand, index funds are passively managed and aim to replicate the performance of a specific market index, such as the S&P 500. Understanding the nuances of each option is crucial for making informed investment decisions that align with your financial goals and risk tolerance. For instance, mutual funds often come with higher fees due to the active management involved, but they offer the potential for higher returns. Index funds, with their lower fees, provide a cost-effective way to invest in the market, but they typically offer returns that mirror the market's performance. This essay delves into the intricacies of mutual funds and index funds. We'll explore how mutual funds are managed, the role of fund managers, and the strategies they use to try to beat the market. We'll also look at the simplicity and efficiency of index funds, which aim to match the performance of a market index with minimal management. We'll break down their differences and help you determine which investment vehicle might be the right fit for you. Whether you prefer the hands-on approach of mutual funds or the hands-off strategy of index funds, understanding these differences is key to making the best choice for your investment portfolio. Whether you're aiming for market-beating returns or seeking a low-cost way to participate in the market's growth, it's important to consider your own financial situation, investment goals, and risk tolerance. Mutual funds might be suitable for those who are willing to pay higher fees for the chance of higher returns, while index funds could be ideal for those who prefer a more predictable and cost-effective investment. This comprehensive guide will equip you with the knowledge to confidently navigate the world of mutual funds and index funds. We'll provide tips on how to evaluate different funds, understand their performance metrics, and choose the right one based on your individual needs. Get ready to unlock the secrets to successful investing as we unravel the complexities of these investment powerhouses. By the end of this guide, you'll have a clearer understanding of how mutual funds and index funds work, and you'll be better prepared to make informed decisions that can help you achieve your financial goals. Mutual funds are often the first step investors take when venturing beyond individual stocks and bonds. But what exactly are they? Imagine a basket carefully curated by a professional stock picker. That's essentially what a mutual fund is. These funds pool money from multiple investors and invest it in a diversified portfolio of assets such as stocks, bonds, or other securities. The allure of mutual funds lies in their active management. A seasoned fund manager meticulously selects and trades assets within the portfolio. Their goal? To outperform a specific benchmark or market index and generate the highest returns possible for investors. However, this active approach comes at a cost. Mutual funds typically charge higher fees, known as expense ratios, to cover the costs of professional management, research, and administrative tasks. While the potential for higher returns compared to index funds is a tempting prospect, it's important to remember that active management doesn't always guarantee superior performance. In contrast to the dynamic world of actively managed mutual funds, where fund managers are constantly buying and selling stocks to outperform the market, index funds offer a more passive approach to investing. Instead of trying to beat the market, which can be both time-consuming and costly, index funds aim to replicate it. They do this by tracking a specific market index, such as the S&P 500, which includes 500 of the largest companies in the United States. Another popular index is the Dow Jones Industrial Average, which tracks 30 significant companies. Imagine a mirror reflecting the movements of the stock market. That's the essence of an index fund. When you invest in an index fund, you're essentially buying a tiny piece of all the companies included in that index. This passive investment strategy eliminates the need for a fund manager to actively pick stocks, which can often lead to higher costs and fees. As a result, index funds typically have significantly lower fees compared to their actively managed counterparts. This makes index funds a popular choice for cost-conscious investors seeking a simple and effective way to participate in the long-term growth potential of the stock market. Their set-it-and-forget-it nature also appeals to investors who prefer a hands-off approach to managing their investments. Over the years, index funds have shown to be a reliable investment vehicle. Historical performance data indicates that, in the long run, index funds often outperform actively managed funds. This is because the stock market, despite its short-term volatility, tends to grow over time. By mirroring the market, index funds capture this growth without the need for constant adjustments. Another significant advantage of index funds is diversification. By investing in an index fund, you are spreading your investment across a wide range of companies and sectors. This diversification reduces the risk associated with investing in individual stocks. If one company or sector underperforms, the impact on your overall investment is minimized. While actively managed funds may promise higher returns, they also come with higher risks and costs. Fund managers may not always make the right decisions, and their fees can eat into your returns. In contrast, index funds offer a more predictable and stable investment option with lower costs and less risk. For those new to investing, index funds provide an accessible entry point. They are easy to understand and require minimal effort to maintain. You don't need to be an expert in stock picking or market timing. Simply choose an index fund that aligns with your investment goals and let it grow over time. As the financial landscape continues to evolve, index funds are likely to remain a cornerstone of passive investing. Their simplicity, cost efficiency, and proven track record make them an attractive option for both novice and experienced investors alike. Whether you're saving for retirement, a major purchase, or simply looking to grow your wealth, index funds offer a reliable and effective way to achieve your financial goals. Now that we have a clear understanding of what mutual funds and index funds are, let's delve into the key differences that set them apart. First, the management style. The most significant distinction lies in their management approach. Mutual funds employ active management, with fund managers making strategic decisions to try and outperform the market. These managers conduct extensive research, analyze market trends, and make calculated bets on which stocks or bonds to buy or sell. Their goal is to achieve returns that exceed the market average. This active management can be beneficial in volatile markets where strategic decisions can lead to significant gains. However, it also means that the success of the fund heavily depends on the manager's expertise and judgment. In contrast, index funds follow a passive management style aiming to mirror the performance of a specific market index, such as the S&P 500. This means that the fund's portfolio is designed to replicate the components of the index it tracks. The primary objective is not to outperform the market, but to match its performance. This passive approach reduces the need for constant buying and selling of assets, resulting in lower management costs and fees. Second, the costs. Due to the active involvement of fund managers, mutual funds typically have higher expense ratios compared to index funds. These fees can include management fees, administrative costs, and other operational expenses. Over time, these costs can add up and significantly impact your overall returns. For instance, a mutual fund with a high expense ratio might erode a substantial portion of your gains, especially in a low return environment. On the other hand, index funds with their passive management have much lower expense ratios. This makes them a more cost-effective option, particularly for long-term investors who are looking to minimize fees and maximize returns. Third, performance. While mutual funds have the potential to generate higher returns, their performance is not guaranteed and can vary significantly depending on the fund manager's skill and market conditions. Some mutual funds may outperform the market during certain periods, but they can also underperform during others. This variability can make it challenging for investors to predict future returns. Index funds, on the other hand, offer more predictable returns that closely track the underlying index. Since they aim to replicate the performance of a market index, their returns are generally more stable and less subject to the whims of individual fund managers. Finally, risk and diversification. Both mutual funds and index funds offer built-in diversification by spreading your investment across a basket of assets. This helps to mitigate risk by not putting all your eggs in one basket. However, the level of risk and diversification can vary depending on the specific fund's investment strategy and the underlying index it tracks. Mutual funds may invest in a wide range of assets, including stocks, bonds, and other securities, providing a broad level of diversification. Index funds, while also diversified, are limited to the components of the index they track. This means that their diversification is inherently tied to the index's composition. In summary, the choice between mutual funds and index funds depends on your investment goals, risk tolerance, and preference for management style. If you prefer a hands-on approach with the potential for higher returns and are willing to pay higher fees, mutual funds might be the right choice for you. However, if you seek a cost-effective, low-maintenance investment with predictable returns, index funds could be a better fit. Understanding these key differences can help you make an informed decision and align your investment strategy with your financial objectives. Remember, both mutual funds and index funds have their own set of advantages and disadvantages. It's essential to carefully consider your individual needs and conduct thorough research before making any investment decisions. Consulting with a financial advisor can also provide valuable insights and help you navigate the complexities of the investment landscape. By doing so, you can build a diversified portfolio that aligns with your long-term financial goals and helps you achieve financial success. Thank you for watching. We hope this comparison has provided you with a clearer understanding of mutual funds and index funds and the key differences that set them apart. Happy investing!